Welcome to our Chapter 4 video lecture. In this chapter, we're going to cover the income statement, other comprehensive income, and the statement of cash flows. So the income statement is also known as the statement of operations or statement of earnings, and basically that just tells us how well the company performed during that period of time. Our comprehensive income, or other comprehensive income as it is commonly called, basically tells us gains and losses that are really normally not part of net income. And lastly, our statement of cash flows, basically that tells us where and how we spent the money, where cash receipts came in and how we dispersed the cash during the period of time as well. So basically what we're doing here is we're reporting changes in stockholders' equity, like the income statement, the statement of cash flows. These are known as change statements. And then anything that we report changes in cash would be our balance sheet or our position statement. So here we're going to discuss the importance of income from continuing operations and the various components of income from continuing operations. Continuing operations is the main bread and butter of our organization, right? It includes the normal revenues, expenses, gains, losses, that transactions that normally occur periodically. So revenues are inflows of providing goods and services to customers. Expenses, outflows, what we spend when we're generating. So we have the matching principle, which tells us that we have to match revenues with expenses. So we match the revenues and the expenses we incurred to generate those revenues. And expenses also represent the costs of providing goods and services, such as cost of goods sold. So that there is a causal relationship between revenues and expenses. So basically, then the expenses are reported in the same period that the revenue is recognized. If it isn't, then we just can record it to the particular period it relates to, or we might allocate it over several. But normally when you're talking about revenues and expenses, if it does this causal relationship, then we have to adhere to the matching principle and record them in the same period. So gains and losses, those are either increases or decreases, and they're just incidental or outside transactions, maybe from the sale of an equipment or a building or operating assets, not your normal course of business. So here we have our income from continuing operations. So note here we have sales revenue minus cost of goods sold equals our gross profit. Then we have our operating expenses such as selling, general, and admin, our R&D. Note now that R&D is always expensed, and some restructuring costs to get to our operating income. So this number right here tells us pretty much how much we generated from just our normal operations, our normal course of business. So if we're Apple, then it would be from selling iPods, MacBooks, and all types of products. Then we have other income and expenses to get income from continuing operations, and then our net income, our income tax expense as well. There are two types of income statement, one being the single step, which just basically includes all revenues and gains and then all expenses and losses together to get to our net income. Notice there is a double line in our net income, and single lines are used for subtotals. Then the multi-step, which is probably the most common, has our normal sales revenue minus cost of goods sold equals your gross profits. Then it gives you your operating expenses to get to your operating income, then to finally get to your net income. So please be sure you know both methods, and you will be preparing these in your homework. So now we're going to discuss earnings quality and how that is impacted in practices by management and also to manipulate earnings. So earnings quality is basically your ability as a company to report earnings, and then we report these earnings to predict future earnings. So we have transitory earnings, which are basically, they're not likely to occur in the future, but they're likely to have a different impact in the future. Then we have permanent earnings, and these result from things that we're likely to do. And so this is usually included in continuing operations. So this is the one that we care about a lot, because we want to make sure Apple has permanent earnings if it continues to sell all of its products. And then transitory earnings might relate to just those extraordinary items or the sale of equipment that normally might not take place. Now, executives such as the CEOs and the CFOs, they're both responsible for this. They report earnings. They like to have a smooth, regular pattern. So basically, they want their earnings to be understood, and they want to make sure that everything works well. So if there's earnings of 15%, they want to say it's 30%. So when they try to manipulate earnings through channel stuffing or big bath accounting, big bath meaning that if you're going to miss your earnings expectations. So usually your earnings per share, so they'll say, oh, Apple's expected to release earnings and it's $1.50 per share, but say they're going to completely miss it, then they might just say, well, we're going to take a big bath and do all of our losses at this point. And then channel stuffing is where you're just shifting income from one period to another. All not acceptable. So the components of operating and non-operating income, and how do they relate to earnings quality? So here we see for GameStop, we see their income statement. And then here we know that there's an extraordinary classification, and that's been eliminated now from GAAP. So we no longer have extraordinary items. So make sure extraordinary items, that classification has now been eliminated from GAAP. So you just have now your goodwill impairments and your asset impairments. Those are just considered as part of a regular expenses. Then we have restructuring costs, and this is when you're trying to relocate or shut down or downsize an operation. And now these are recognized in the period of the exit or disposal when it's actually incurred. So for example, if you're going to terminate some benefits payables to employees that have been terminated, you would accrue that in the period that they rendered the services. And then cost associated with closing the facilities, now you're going to do that when those activities are actually received. So these are just a little bit of changes that GAAP is taking into effect. And if you are going to take the CPA exam after 1/1/2017, this will be on your exam. So we have long-lived asset impairment, and any long-lived asset should have its balance reduced if there is a significant impairment in value. Notice tangible has physical substance, intangible does not. Remember, tangible are depreciated, intangible are amortized. So here, if you lose a major customer and that can't be replaced, that could be an issue. And also if you have permanent revenue recognition due to the pressures of meeting earnings expectations. Then we have gains and losses, such as if you're selling investments, and pro forma earnings are your projections. So now what happens is the Sarbanes-Oxley, it requires you to reconcile your pro forma earnings to what you have from GAAP. So now there's that reconciliation. So here's your gain on investments. Now that is shown. And this concludes this video lecture, and please proceed to the next one to finish our discussions on Chapter 4.